Let's now discuss the brand value chain. The brand value chain is a structured approach to assessing the sources and the outcomes of brand equity. The brand value chain is therefore useful to assessing the return on investment of various marketing and branding efforts. The brand value chain recognizes that many people and things within and external to an organization impact the return on investment of these various marketing and branding efforts. The green boxes highlight value stages, where value is created and contributes to the value created in later stages, which ultimately impacts shareholder value. Note that the marketing program investment focuses on firm controllable factors that can be altered to produce changes in the customer's mindset. These changes in the customer mindset impact how the brand performs in the market, which in turn impacts shareholder value. The blue circles indicate multipliers. These multipliers refer to levers that influence how much a value stage impacts the next value stage. So these multipliers can amplify or diminish the impact that a value stage has on the next value stage. The first stage is the marketing program investment. Marketing program investments impact the customer mindset. A marketing program investment refers to any effort that can contribute to brand value development. These include things like changes or creation or the deletion of brand elements, advertising, personal selling, publicity, promotion, product development, and so on. The impacts of these marketing program investments on the customer's mindset are influenced by the marketing program's quality. So marketing programs that are more unique, that are more relevant to consumers, that are comprised of integrated marketing efforts that complement each other well and also are well done, they're going to result in greater impacts of any marketing program investment decision on the customer's mindset. The second stage of the brand value chain is the customer's mindset. And the customer's mindset value stage captures the brand resonance pyramid that we recently discussed. The customer's mindset includes everything that exists in the mind of the consumer. Right? There's a lot of thoughts and feelings, experiences, images, perceptions, beliefs, and attitudes that are relevant to a brand. But because the mindset's so broad, brand managers choose to focus on a more narrow set of aspects in many cases. And those that they choose to focus on tend to be brand awareness, brand associations, brand attitudes, brand attachment, and brand activity. So brand awareness refers to the extent and the ease to which a brand's recalled, recognized, and identified by consumers. Brand associations refer to the strength, the favorability, and the uniqueness of perceived brand attributes and benefits. Brand attitudes are overall evaluations of the brand with respect to its quality and the satisfaction that it affords. Brand attachment refers to the loyalty that customers feel and show towards a brand. And then brand activity refers to the extent to which consumers use, they discuss, and they seek out content regarding a brand. Now, the customer's mindset is important because it impacts the market performance of the brand. And the impact of the customer's mindset on the market performance of the brand is influenced by the marketplace conditions multiplier. The marketplace conditions multiplier is so named, is designed to capture how market factors impact the influence of the consumer's mindset on market performance. Actions by competitors may, for example, reduce the impacts of the customer mindset on market performance. If a competitor has really well done marketing communications, or maybe they're running very attractive sales promotions, then the impacts of the customer's mindset on marketing performance may be lower. Also, the support a brand receives from its channel impacts its market performance. A retailer, for example, that offers to move a brand's offerings to a more favorable location in its stores may increase the impact of customer mindset on market performance. And also the size of the market and the characteristics of the consumers, such as their usage patterns, may result in the relationship between customer mindset and marketing performance changing. The third stage of the brand value chain is the market performance. The market performance can capture many different aspects of the brand's success or failure in the market, and the importance of each factor generally varies across brands based on the industry that they're in, the positioning, what their objectives are, etc. But market performance is typically assessed by price premiums, price elasticities, market share, brand expansion, cost structure, and profitability. Brands that have higher market performance, well, they command higher price premiums. They can increase prices with less loss of customer business. They also tend to have greater market share, and they have more success when they're introducing new products and expanding into new markets. And they also can get a higher return on their marketing efforts because those marketing efforts produce customer outcomes with greater efficiency. And they're also more profitable. So market performance, of course, is going to translate into greater shareholder value. Now, the extent to which the market performance impacts shareholder value is shaped by the investment sentiment multiplier. The investment sentiment multiplier includes things like market dynamics, growth potential, risk profile, and brand contribution. With regard to growth potential, investors that believe the brand has, with regard to market dynamics, investment rates, investor sentiment, and supply of capital, all can alter the impact of market performance on shareholder value. For example, when interest rates are higher, investors tend to find bonds more attractive. So higher interest rates can reduce a positive impact of market performance on shareholder value. With respect to growth potential, investors that believe the brand has ample opportunities to either increase its revenues and or expand into new markets may pay a premium for market performance. Furthermore, brands that are at greater risk to various factors may be discounted by investors. Investors, for example, might discount a brand if they think that there's substantial risk due to the brand's dependence on a supplier, a distributor, or a market. The shareholder value is the final stage of the brand value chain. And this includes the firm's valuation, the stock price, the price to equity ratio, and other factors. The brand value chain is valuable because it offers several different implications to branders. First, it highlights that value creation begins with the marketing program investment. So it's very critical to ensure that there's funding available for marketing and branding efforts, and the people that are performing marketing and branding efforts can do so capably and competently. Second, it emphasizes that the value creation for shareholders depends on many different stages because of the value transferring across such stages. Third, the brand value chain provides a conceptual roadmap that details how value creation occurs. So applying proper metrics allows brand managers to identify opportunities to create greater value. And lastly, the market feedback offers insights in terms of what it is that can be revised with marketing and branding efforts in order to bring out improvements to the customer mindset and therefore market performance and shareholder value.